Good morning, everybody. You are watching a live daily market outlook from Windsor Brokers for Thursday, 7th of March, 2013. My apologies for missing of two previous sessions. I was away, unfortunately, and then there was no replacement arranged due to the short notice. However, we are back to the business, and after yesterday's quite turbulent day, another one is ahead of us. Thursday's full calendar promises a lot of action today. As a result of yesterday's movements, we can summarize it as dollar is the top winner of the day, and hovers near its highest levels in the past 6.5 months against the basket of major currencies. After yesterday's solid job data fueled hopes of recovery in the U.S. labor market, the one that is the quite painful point for the attempts in the recovery of the U.S. economy, and basically one of the key conditions for the Federal Reserve to wind up its massive stimulus program. From the other side, the British pound lost ground again and fell to its 2.5-year low as market players positioned for more stimulus from the Bank of England as early as today, as the U.S. economy faces the threat of a triple-dip recession. As said, sterling again dipped below psychological 150 level that sees risk of further decline and further losses that might be seen on today's release. Of course, we have two central bank releases today that are among the most important economic indicators releases for today, ahead of course, tomorrow's a very significant U.S. non-farm payroll. So this is promising quite a lot of action in the market in the coming today and tomorrow. Basically, the yen and the euro were undermined by expectations of the Bank of Japan and the European Central Bank could ease in the future, although Bank of Japan stood pat during the night on their interest rate release, and the ECB is expected to follow suit later in the day. One of the reasons the dollar is broadly strong could be that while the world, many other central banks are looking for more easing, at least at the Fed, the debate is about exiting from stimulus and not doing more of it. So this is basically one of the quite supportive elements for the greenback. From the commodities, gold remained supported on yesterday's movement, and overnight it's slightly above its recent lows. The gains were fueled by Wall Street rally as Dow Jones reached its record high yesterday, and this is underpinning also gold. From the other side, the crude oil is slightly recovered from yesterday's dips when the oil price dipped as low as 89.55. We're talking about April U.S. oil contract after the release of U.S. oil stock data showed a build of 3.8 million barrels compared to 900,000 barrels forecasted. Overall, the negative tone persists on the crude oil and sees more risk towards the downside according to the technical structure of the crude oil's outlook, while the fundamentals are also not that bright. So overall, it gives quite a lot of pressure to the oil price. We are going to take a look at today's calendar that is quite busy, and quite important releases are due to come out. So let's start with the what did we have already released? Said overnight call rate from Bank of Japan came as expected. No changes in their policy and the rate. Still to come, we have the Bank of Japan has already been released. Swiss Chairman Jordan is due to speak at 9 o'clock GMT. Factory orders from Germany at 11 o'clock, 0.6 versus 0.8 previous release, and then comes the one of the first of the top releases. official bank rate from Bank of England due at 12 o'clock GMT. No change in the rates, as well as asset purchase facility. Of course, this is forecast. We have to see what is going to be the final verdict of the central bank. As I said at the beginning, further easing is not ruled out at this point. European Central Bank comes after with interest rate expected to stay unchanged at 0.75%, but more interesting will be the comments from the President Mario Draghi that is due at 13:30 GMT, and then he will give us some more hints as usually what are the further steps of the European Central Bank. As at the beginning, some movements could be expected at the later stage, not on today's meeting. A bunch of data from America's Canadian building permits due at 13:30 in January. According to the forecast, great improvement by 5.4% versus the fall in December by 11.2%. Canadian trade balance, I have feeling that we have a wrong figure. Okay, it's the mistake in percent. It's a billion, not the percentage. I do apologize for this. 600 million trading gap is forecasted in January compared to 900 million gap in December, narrowing the trading gap in Canada. U.S. trade balance is forecasted further widening of the gap as the release is at the same time. January forecast is minus 42.8 billion US dollars compared to minus 38.5 in December, further widening the trading gap of United States. Unemployment claims weekly release, 354,000 new claims expected in the previous week compared to 344 in the week before. Again, the most painful job market is showing some signals of weakening according to the jobless claims. Consumer credit from United States due at 15.2 billion compared to 14.6, and bank stress test results are due at 21.30, and this is all from Western world. Eastern world starts with Japanese current account for January that is expected to stay unchanged at 0.11 trillion Japanese yen in January. Final GDP for the fourth quarter is also seen unchanged from the first one, contracting by 0.1%, and final GDP price index 0.6%, contracting the same like in the third quarter. And that's all from the calendar. Again, quite important things. What the Swiss National Bank Chairman Jordan will say, and of course the releases of European central banks, UK and the Eurozone European central banks are the top releases for today. And we're going to look at the technicals and see the expectations for today and for today's trading for the major currencies and the commodities. Do we have a question? Triple dip recession was mentioned for the UK, not for United States. So this is the point. It's not US, it's UK. Anyway, let's start again. Euro is gaining some speed at the beginning of the European session after dipping as low as at 129.49 in late yesterday trading, following the broader weakness of the pair that's commenced from 137.10, and the pair is channeling lower. 21.29.49 seen lowest after breaking a psychological 130.00 support. Technicals hourly indicators are now strongly pointing higher. That gives signal for some more serious corrective action, as the pair now so far retraced approximately between 23.6 and 38.2 on the hourlies, descent from 131.61 to 129.49. Still a lot of barriers to be cleared. The 130.30 is 38.2, and the 130 where is also the a broken bull trend line of the previous low at 129.65. Overall negative tone still dominates on the lower time frames as shown on the hourly chart, despite RSI now moves slightly higher. I wouldn't see anything as serious movements as long as we are at least initial barrier at 130.74, which is the high of 5th of March. That might signal some stronger action ahead, but more significant is seen the high of 28th of February at 131.61, where it's also standing the channel resistance, and basically only a break below this level could give some more impact to the current recovery attempt. This is still seen as corrective action. That does not promise much of action towards the upside as long as strong pressure, at least from the technicals. Of course, today's ECB's action will give us, of course, also more clues about the current situation. Daily structure is quite negative, and yesterday's big black candle is signaling that possibility of further extension lower is quite likely, especially that we broke below this near-term congestion and posted a fresh low. Current movement seen as clearing positions, a bounce on oversold conditions as long as we are below initial 130.74. Of course, we have 130.36, which is the trend line resistance, and Fibonacci 130.74, I would say, says 130.80, where 61.8% is seen as a trigger for some more significant action higher. But again, a break above 131.61, previous high of 28th of February, and trend line and channel resistance would signal some more significant correction. Still seen as correction, as we are in the stronger downtrend of 137.10 peak of 1st of February 2013, with the targets on the downside still unchanged, 129.00 and 128.76, 50% Fibonacci retracement of the larger up leg, larger rally from 120.42 to 137.10. British pound, as said in the introduction, is still under heavy pressure, as fresh low was posted during the early hours of today's session at 149.63, slightly surpassed the previous at 149.83, giving overall a negative tone, more pressure for further extension of the larger down move from 163.80, 2nd of January 2013 high. Overextended conditions on the daily chart still do not produce any more significant signal of possible reversal, still firmly pointing lower, while the lower time frames are showing hourly showing a basing attempt at yesterday's fresh low 149.63, with the sessions low at 149.66, so far holding the downside. This is just hint of a possible basing attempt. A lot to be seen on the upside in order to confirm the reversal. If we take a look on the Fibonacci levels of the latest move lower, then we can see that around 150, 150.20 we have the previous overnight's highs, and then 23.6% retracement. Basically, the price is still congested between these two levels, and seeing not much potential at the present, though the reversing indicators on the hourly chart might see some stronger attempts higher. 4-hour indicators are still negative, and still see downside at risk as a part of the larger, as we said, a larger down move from 163.80, and the key resistance at this point, the first initial strong resistance is it's approximately 150.60. These are the lows of end of February. Also, these are the lows of the previous multi-year range floor broken earlier in February. But again, more significant is the top, the ceiling of this congestion, which is approximately at 152.20, and if we see the break above here, then some relief could be provided for the cable's near-term price action, and would allow for some a stronger movement higher. Otherwise, more extension towards the south is seen as a quite likely scenario, and we'll be looking for a test of up to 10 to the monthly chart. We set approximately 149.00 as a round figure, and then 148.50, which is a 61.8% Fibonacci retracement of the longer term rally from 2009 low at 135 that peaked at 2009 high at 170.41. Overall outlook is still quite negative, as if we see the Ichimoku studies on daily, they are extremely bearish, and all indicators are still pointing lower. Even the negative 1 hour, despite being overextended, is still seeing more risk towards the downside. What's the next? Dollar yen. As the pair regained the ground after bottoming at 90.85, there was a high risk on a break below the previous range floor at 92.00, with a strong dip signaled by this big candle. I mentioned this in the previous sessions. Signal was given for a more significant reversal. However, the pair managed to find the support, and then steady recovery has regained the ground of on the break from here, and again so far levels at approximately 94 zone, seen as a trigger for a test of our near-term key resistances, and then the previous highs at 94.45 and 94.55. Overall positive tone sees this scenario as the most likely at this point, as the price continues to advance higher, and sees so far no obstacles towards our targets. That will at the later stage open our initial target at 94.97. This is the high of 2010, and the most likely scenario will be test of these levels in the coming sessions. Our restructure is positive. A brief pullback of yesterday's fresh high at 94.10 was contained by 20 days exponential moving average at 93.80, approximately close to the previous high that ideally held the downside, and we see more potential towards the upside, especially that the dollar is stronger across the board, and sees prospect for further extension higher. Overall picture on the dollar yen is positive. 4-hour indicators are still firmly pointing higher, and looking for today in the coming sessions for the test of 94.45 and 94.55. And finally, from the major currencies, we're going to take a look also on some others that are quite interesting. Dollar Swiss continues to advance. 94.85. It's approaching. It's our next upside target, which is at 95 zone. We have a 50% retracement of the larger 99.70 to 90.20 down move at 94.95, and the peak of 11th of November, 2012 at 95.11. This is our initial target zone, and most likely we're going to see it in the short term as the pair remains well supported. Of course, corrective action, this was mentioned in yesterday's comments, corrective action may precede the fresh attempt at 95.00, as this is acting as quite a strong resistance and the break point, as well as overextended conditions now showing on the hourly chart, already emerging out of the overbought territory. RSI is firmly lower, MACD, and momentum breaking below 100 line. That will allow for some corrective action before we see the fresh attack higher. Initial support, the previous high at 94.61 now comes under pressure. We have some other previous tops, 94.39 and 94.31 seen as the next supports, while more significant is the 94 zone. 93.91 is the previous consolidation range floor, and basically this level is ideally seen containing dips in order to keep immediate bullish structure intact for possible attack towards 95 zone. And 94.38 as set zone is equivalent to 23.6 of 92.78 to 94.87 ascend, and then the other one is 94 zone around figure 38.2%, and the previous lows at 92.90 overall, giving a quite significant support, and basically holding a reversal seen at or above these levels will be seen as ideal for fresh extension higher. On the 4-hour chart, indicators are starting to move lower. We can see the RSI is now below its 7 days moving average, and emerging out of the overbought territory. MACD is showing an initial signal of bearish divergence that is shown on the 4-hour chart. We can see the lines. That could be initial signal for some stronger corrective action. Momentum versus 7 days moving average is pointing lower, still holding above its moving average. Stochastic is reversing, but still above the 80 line. Overall, corrective pullback could be seen, is seen quite likely in the near term, but ideally this should be held somewhere around 94 in order to keep immediate bulls in play for a test of our target at 95 zone. Look for the supports below 94 at 93.50 zone, which is the previous range top, and in case of break below 94, this is the next very significant and strong support. We're going to take a look also at Aussie dollar. That is quite interesting. I mean, most of the instruments are very interesting. Situation goes as follows: corrective rally from 101.14, 4th of March, low reached 103.00, where the gains were capped for a pullback that was contained at 102.33 so far. Basically, if we take a look, it's contained by 20 days moving average. At this point, there was a few spikes higher, and the fresh rally is now underway. We will be looking again most likely for a test of 103 and possible break higher, as situation for our chart shows enough room for extension towards the upper boundaries 103.00. Then we have 103.27 and 103.39. So this is seen as quite a significant resistance zone, and seen as a near-term target on the upside break above 103.00, while the 102.17, I do apologize, low offers initial and good support for now. This is also between 38 and 50% retracement of the entire 101.14 to 103.00 up leg. A positive tone again is emerging on the hourly chart, that overall in the near term gives a signal for possible test of 103 and extension higher towards 103.30-40 zone, our next upside targets, with the daily structure still being quite negative. Initial movement higher of the indicator starting to point higher sees a probability of some more significant corrective action ahead. So basically the pair broke below the recent, I would say, a larger range floor that has been established in approximately in July 2012, briefly denting the support on the dip to 101.14, and the quick recovery proved that this was a false break, and we might see some extension higher in the near term. On the upside break above 103, 103.30 would look for this is was also equivalent. The next targets are also equivalent to 200 days moving average, just seen as a quite strong barrier. And if we see break above here, then and the next significant levels come not far from this 103.56, 50% retracement of the entire down leg from 105.97 to 101.14, and the recent peaks of mid-February at 103.73. Overall, we have quite strong barriers above 103 at between 103.30 and 103.70, seen as important, and the break point break above 103.50-60 zone is seen as a pivotal for some stronger recovery. Basically, it will confirm that the pair remains in the larger picture range. As we can see, the range has been established in sometime at the beginning of June 2012, and since then the pair is entrenched between the 106 on the upside and 101.50 on the downside. The recent attempt lower was not successful, proved the false break as the price quickly recovered up to 103.00. Quick look also at the commodities. Let's take a look at the yellow metal to see what is developing on the daily. Quite extended conditions of the daily indicators with slight attempt to point higher, resulting in the near-term recovery of recent low at 1554 posted on 21st of February, with a series of higher lows 1564 and 1567, signaling possibility of some stronger recovery. Basically, the rally peaked at 1619, and that was all seen following the fresh dip lower. Some corrective action cannot be ruled out, as initially the hourly indicators now moved out of the negative territory, and they see potential for some stronger recovery. Of course, we need to see the clearance of this congestion and the range tops that are approximately at 1585, 1587 zone, reinforced by 38.2% retracement of the down leg from 1619 to 1554. And if you see break above this level and another significant, which is very close, 50% retracement at 1592, then we'll be looking for a test of 1600 psychological and the 61.8% retracement. That may open way for test of our recent peak at 1619 and allow for some stronger corrective action of the larger down move from 1684 to 1554. Overall, the pressure on the downside still remains. 4-hour indicators still weak, though some bullish momentum has been seen, but as long as I said, as long as this 1590 outside zone holds the upside, reinforced by 55 days exponential moving average, we cannot expect much prospect towards the upside. Again, the moving averages are showing some positive signals as the 10 days one crossed above the 20 days one, and the 55 days moving average is now moving sideways. That signals consolidation and averts immediate downside risk at 1554, and at the later stage possible test of 1520 critical support. But again, and a lot of work seen on the upside in case of a break above 1590 to open way towards initial 1619, 1620 high posted on 26th of February 2013. And finally, crude oil, that is showing signals of a recovery of yesterday's, the 4th of March fresh low at 89.35. Yesterday's marginally higher low, at 89.55 is signaling a possible consolidation of the larger fall from 98.63. This is the highest seen on 13th of February. Some consolidative action could be seen now, and basically break above the range top, which is at 91.15, would be initial signal for some stronger corrective action, and would avert immediate downside risk. As we said, we were looking for a extension down towards 89.00 and then 88.37. That marks 76.2% retracement. Significant was attempt that is still not cleared and confirmed below 200 days moving average. We can see basically that sort of indecision is seen, though we have no doji candles, but movements within the similar range of the candles is showing that the pair is currently attempting to consolidate recent heavy losses and still having the clear decision in the near-term action as it's hovering around the 200 days moving average, and also 61.8% retracement of 85, 20, 98, 63 as said. But as said again, overall negative tone is still seeing a more risk towards the downside as long as we are holding below the levels previously mentioned. Initial barrier is 91.15, then 92.00, and break above 92 as a previous base would be a signal for some more significant bounce higher. 92.00 is above, it's between 23 and 38.2% retracement. A break above 93 is seen as a more significant at this point. These are the highs of end of February 2012 consolidation range tops, and break here and break here, pardon, is to trigger some stronger recovery. Otherwise, any movement higher below that will stall or run out of steam below these levels could be seen as corrective action and preceding a fresh extension lower. And I think we finished comments what I had in front of me listed to present. Do we have any questions from your side? No questions? It means either I'm doing a great job or you are just speechless after my presentation. In any case, I would like to thank you all for being with us. Again, apologies for missing the past two sessions. We are going to continue regularly as from today, and the next session will come regularly as is supposed to be tomorrow morning when we will see the movements of today. Again, quite busy days ahead of us regarding the number of economic indicators releases, and I suggest strongly that you keep an eye on the releases and comments, especially from the central banks, that will give us some more hints about near-term direction of all instruments or those that you trade. Again, we're back tomorrow morning, Friday at 8 o'clock GMT. Until then, I wish you a nice Thursday and the most important, successful and profitable trading. Good luck.